Hello, good afternoon. Welcome to Mutual Fund Corner on CNBC TV18. I'm Vinny Motiwala and thank you so much for tuning in. Today, what we're going to be putting the spotlight on is stress test results that have come in for the small cap mutual funds. And this is at a time when the market has been so volatile since January. We've seen a fall coming in for small cap, mid cap sides specifically. And even in terms of funds, if you just look at the short term return, we've seen that decline coming in here. Now, we'll touch upon the relevance of conducting stress test results for the viewers, what it means for you as an investor. Also, we'll be discussing more on, what this will indicate, what are the red flags that you all should watch out for from these stress tests as well. To discuss all of this, we have Nirav R. Kurkera, Head of Research at Fisdom, joining in with us to talk to us about all of this. Nirav, very good afternoon, and thank you so much, as always, for joining in with us on the show. I'm going to just start by talking about the basics. First is, what exactly is stress test in context to the small cap mutual funds, and how is it normally conducted? What does this indicate for an investor as well? What should they be making of this?
So, Vinny, always a pleasure chatting up with you on the most relevant topics. So, the stress test is a very recent phenomena. It was introduced by way of a circular / guideline by SEBI. So, for the longest period in time, one of the biggest issues that small cap and mid cap funds would grapple with would be the liquidity profile of the underlying stocks, right? We have often heard about several funds taking exposure to low float stocks, etc., right? And most investors were left in the lurch wondering how could they even assess the liquidity of the portfolios managed by several mid and small cap funds. So here SEBI, of course, in line with its investor protection agenda, decided to bring a certain sense of uniformity and comparability between small and mid cap funds, especially in context of the liquidity of the portfolios that they hold. So SEBI has, of course, outlined a mathematical way in which fund houses are to compute the liquidity of their specific portfolio. While the formula is highly convoluted, I'd say a simple way to look at it is to look at way is funds evaluate how long will it take for them to liquidate half of its portfolio, that is 50% of its portfolio, and at the same time, how long would it take for it to liquidate one-fourth of its portfolio, that is 25% of the portfolio. Now, the math here entails a lot of math around the historical volumes in very specific counters or very specific stocks that they have included in their portfolio. But this serves as a very good yardstick for investors to compare different funds on their liquidity profile. Of course, the standard metric used here is number of days. So an easy way to interpret liquidity stress test is it's going to take X number of days for a fund to liquidate 50% of its portfolios, or it's going to take wide number of days for a portfolio to be for 25% of the portfolio to be liquidated, right? So this is the standard interpretation with which an investor can look at these details, which are now mandatorily published along with the fact sheets every month.
Right. So, Nirav, in short, then, does it mean that if, there are fewer days to liquidate, then that is a better option to go for always? Does it indicate that just as a metric? So, there are other factors also one should watch out for here.
So definitely there are several other factors that one must look at while choosing a mutual fund, especially in the mid and small cap space. But definitely, if you are going to evaluate the liquidity risk involved in two different portfolios, this is a go-to metric. A lower number of days indicate that the portfolio is highly liquid. However, a highly liquid portfolio does not entail a high-quality portfolio or a high performing portfolio as well. It could be very well possible that the liquidity of a portfolio might be slightly low, but at the same time it could be a very good portfolio. So this is just a starting point. This is just a risk assessment metric. This is not going to be your foundation for deciding which fund to go for.
It's just one of the things that you should keep an eye out on when you are investing. Not the most important one. There are other factors also that you should keep an eye out on. Nirav, one point that I want to understand, while fund houses carry out and evaluate this metrics in terms of stress tests for small cap funds specifically, but how is it important in terms of during these market downturns? How do they evaluate during that time? Liquidity crisis, these are concerns that come in as well. So is there some different matrices that they also follow during this time?
The beauty about this metric is that it is to be held uniform across market cycles. And, it is only when the tide goes out that we get to actually see how liquidity profiles are being managed. So, during an uptrend, and typically, when the volumes are really high, it would be very easy for most stocks to enjoy a higher float or higher degree of volume and a higher liquidity as an after effect of it. But during troubling times, it is when it is actually put to stress. So this is what the stress test tries to really bring out. So it tries to highlight the liquidity of a portfolio even when under pressure. So during good times, of course, no one's talking about liquidity, no one's talking about risk, but it is during such scenarios where this particularly comes handy.
So Nirav, this is the right time to check this, right? Then which is the best fund for you in terms of liquidity as well? Given that small cap, mid caps have seen that fall, then would this be the perfect time to judge the fund as well and make those interpretations?
Absolutely. Now is a wonderful time to look at it because the recent bout of pressure that we have been seeing in the mid and small cap segments, especially over the past 2 quarters, makes it an opportune moment to distinguish the boys from the men when it comes to fund management and liquidity management, especially in the small cap segment where it is all the more critical. It is very easy to get trapped in low float stocks, low volume stocks. So there's a risk that really materializes during such periods. Of course, I would insist and implore that checking this metric should be a part of your standard checklist across various cycles. But if you haven't been doing it till now, and now is a wonderful time to start doing it.
Absolutely wonderful time to start doing it. Are there any specific red flag, if they start seeing this, that one should watch out for in this stress test as well? Like, what is the most important thing that they should check, right? And right now, like you were mentioning as well, that, this is the time to check. So if anything as a red flag that pops up in your small cap fund, then should you just get out of it, or what more should they follow as an investor?
Absolutely. So I'll take the latter part of the question first. If there's a red flag, absolutely, that's the purpose that a red flag serves. That should, while it can, it should not directly warrant an action, it should definitely warrant an investigative behavior as an investor, wherein you must go in deeper and go in for a full-blown root cause analysis to understand why is the red flag showing so, and if it is going to be pertinent even going ahead, and does it derail your entire investment thesis. So definitely keep a watch out for red flags. That's point number one. Second, what are these red flags? Of course, the most, in the face metric is the number of days to liquidate a portfolio, 50% of the portfolio. That is the number one thing. If you feel that your portfolio is taking much longer to liquidate in a hypothetical scenario versus, what the rest of the category averages are taking. Now, this is very simple to look at, right? Amphi publishes so that is one red flag. You need to get in deeper. There are a couple more metrics that comes along with the disclosure. Like another metric could be investor concentration. If a particular fund has a very high degree of investor concentration, and by that I mean a very large percentage of the total assets it managed being controlled by a very few individuals, that could also be a concentration risk, and that could potentially lead to a liquidity risk. Now, imagine a situation where a large chunk of your AUM is held by a small clutch of investors, and all of them decide to redeem together. Now, that's going to put a lot of pressure on the fund manager, and that would lead to distress selling, which will impact the NAVs for others as well.
Okay, Nirav, the days, I want to just know, on an average, what is the number of days that one should keep, and be like, okay, this is okay if, I take so many days to liquidate my fund. What is that number that we should keep an eye out on?
So there is no such golden rule on how many days is good enough. But what you must observe is the trend for a particular fund. How is the trend going? If you see it is slowly and gradually becoming more and more illiquid, that is, the number of days are increasing, that should be a red flag. That's number one. Number two, you must always compare it with category peers, and you must see if the days are exorbitantly high versus what most other peers in the same segment are exhibiting on an average. Now, you must take into context for larger fund sizes. Of course, this is not a given. I know there are several large fund houses that manage a highly liquid small and mid cap profile, at least relatively. But the larger the size gets, you can often notice a tendency for the liquidity to really drop because they inadvertently need to invest more and more into counters and absorbing a lot of liquidity themselves. So you must take that into context. And number two, you must place these number of days also into market context and see if it is your particular fund that is under stress, or is it a market phenomena that the volumes are drying up in a particular segment, etc. Right. So context is of key relevance over here. So while there's no golden rule, I feel the two things that you can do: compare it with the category peers and compare it with its own historical trends.
Okay, own historical trend as well as category peers. One thing, when I think you had done a detailed research in terms of this as well. So what I was looking at in terms of that was that cash holdings for some of these funds were as low as 1.5%. How does one actually, what should one make of this? How do fund managers plan to handle the redemption during such a time and a downturn, right? If there are red flags coming in or if the liquidity is an issue, then how would they be managing that? And is that also a concern that we should watch out for?
That's a wonderful point, Vinny, because cash holding is indeed very critical to fund management, also from a standpoint that it helps cater to redemptions, right? But like you rightly pointed out, there are a few funds that have decided to maintain very low cash levels, and nothing against it. They might have a philosophy that they want to participate in the markets as much as possible, right? So there are a couple of ways in which fund managers mitigate the liquidity risk despite deploying a high degree of the cash available. So number one is managing liquidity through more liquid counters, right? Although it is not in cash, there could be an allocation towards very, very high liquidity, large cap or blue chip stocks as well, right? We know the volumes are pretty good over there. We know there's market depth over there. So even though there is very limited cash available, the fund manager can very easily liquidate some of those holdings without as much of an worry about the impact cost, and yet manage to cater to redemptions. That's number one. Number two, the low cash holding is not written in stone, right? So slowly and gradually, with time evolving, with the warning signs flashing and the red flags, propping up, it gives fund managers enough buffer time to increase their intermittent cash holdings, even if if the tides turn south, intermittently. So that is not something reported exactly at the month end, but there could be intermittent management of cash holdings to cater to redemptions if the fund manager senses any trouble
Sure.
brewing in their portfolio.
Okay, Nirav, thank you so much for that there. We'll keep an eye out on those points. But on that note, we're going to sip into a very short break. Do wait with us, Nirav. We'll continue this conversation after the break. Welcome back to Mutual Fund Corner on CNBC TV 18. Thank you so much for tuning in. We're discussing today is stress tests on small cap funds, what it indicates for you all, and we have with us Nirav Kharkera. Nirav, let's continue the conversation forward. Now, when I was analyzing the data you sent us as well, it also showed that, some of these funds had over 22% that was held by top 10 investors, right? So if they make an exit, then it does destabilize the fund as well on some sort, or does it start worrying? And is there a way that we could actually check on this or figure out anything in terms of red flag that comes in from that front?
So, Vinny, as a part of a previous response, also, I just briefly touched upon it, but I'll also elaborate, right? As a part of the disclosures, fund houses also disclose what percentage of the portfolio is concentrated in the hands of, let's say, the top 10 investors, right? Now, the risk that comes along with concentration risk is an event wherein this very small clutch of investor press the redeem button. The fund manager is required to create liquidity in a very short span of time, right? So a high investor concentration could also potentially lead to a liquidity risk. So this implies that when a fund manager tries to liquidate a large amount which is controlled by a limited set of investors, the fund manager also runs the risk of impact cost and may probably under pressure need to sell at lower levels, which impacts the overall NAV of the fund, which implies that even the rest of the investors who are still invested will sort of have to bear the brunt of this post redemption, right? This becomes a challenge in particular. So this is one thing that you must be on the lookout for. Of course, this is a more common phenomenon in smaller funds with smaller asset sizes, with very new funds, because they have limited investor bases. The investor concentration could look like really, really high. But for the ones that have been around for quite some time and enjoy a very granular subscriber base, uh, they typically have a well
Sure.
diversified AUM per client sort of a metric, right? So this is something you can look out for
Right.
when you look at the disclosures.
Absolutely. Yeah, you had mentioned that concentration risk also that comes in there. One thing, Nirav, is that are there any other tests that can be done, so that an investor or a retail investor can figure things out? Is there something one can do by themselves, to take measures?
So there are a couple of things, but it's not going to be easy and straightforward. There are, of course, disclosures and data available, but I'll probably talk about a few simple things on the same lines,
Yeah.
right? Number one is no matter what metric you look at, as a guiding principle, always look at it in context. So we spoke about number of days to liquidate. We spoke about, the investor concentration. Apart from that, you must take into conjunction how the performance has been doing in context of all of this that we spoke about, right? And how is the performance doing vis-a-vis the risk that it entails? So, for instance, standard deviation, right? So, standard deviation is a known risk. A very close proxy that is also published is Sharpe ratio, right? So, you can look at how well the Sharpe is looking versus other funds in the same category. This should be a good proxy of the risk-adjusted returns, and this is market risk that I'm talking about. So you have ratios like Sharpe and Trinor that is generally disclosed by AMC. So you could probably collect it at the end of the month and do a intra-category comparison. That should give you a whole lot more context in terms of what is the risk you're undertaking and for what kind of returns.
Okay. Surely, that's interesting. One could watch out for as well in terms of the standard deviation levels as well. Because some of them I was seeing is as up to 19.3%, right? So in that standard deviation also, any specific level is there, or, that goes on case-to-case basis?
So in the small cap universe, of course, it is almost as if the sky is the limit in terms of standard deviation. This is indeed among the most volatile segments of the market, which directly translates into higher standard deviation. On an average, we notice standard deviation ranging between 18 to 22 odd figures, right? So that's a typical standard range. However, let me point out any standard deviation beyond or below this range also is not a cause of concern in isolation. What needs to be understood is that, of course, the fund is experiencing a lot of volatility. That's one. But is the fund able to perform while taking on such level of risk? So that's the number one check. Basis the standard deviation, what's the kind of returns that they're using? And I just spoke about Sharpe as being a good metric to capture this effect. So that is one. If your risk adjusted returns are looking good. Number two, you must check if this is in line with the volatility that you want in your portfolio. Right. So one is to optimize for the market cycles, and second is to optimize it for your own investment strategy. So the second part is also as critical. You don't want to just maximize your returns and just maximize your risk-adjusted returns. You want it to be in line with your larger objectives. So these are a few things that you must include while looking at standard deviation. But in small caps and mid caps, it's going to be typically high. You have to be prepared for it. That's the nature of the beast.
Absolutely. But, there's one more thing that I want to know, Nirav, is portfolio PE ratios also, right? Does it mean that higher PE means overvaluation, or is it justified given the growth potential? How should one be judging all of this also in this situation? Specifically, obviously, small cap side, what we're talking about.
Of course. So P is by far amongst the most widely followed metric. But here are a few reasons why I am particularly not a huge fan of PE, at least in isolation, right? So number one, it does not capture for growth effects, right? So PE is basically price to earnings, and it captures price and earnings, right? So it does not capture the growth effect or the anticipated growth very effectively. Second, there's a lot of sector variability. You cannot compare the PE of a stock operating in a certain sector with the PE of another stock in another sector. It is just not comparable because of different earning cycles, etc. Now, talking about cycles, there are cyclicality in earnings that this again doesn't account for. Not all earnings are very linear. There are several businesses that are vulnerable to seasonality and cyclicality. This does not capture that as well. So, there are a couple of such defects. It does not include debt levels as a part of its consideration. So, PE, while a very good indication of valuation, it may not suffice in isolation or standalone as a solo valuation metric. A higher PE may just imply that it trades at a higher PE, and reading too much into that could also sort of set you on the wrong rail, right? So do not try and compare PEs would be my recommendation. Just look at PE as a starting point, as a sanity metric. Just look at it, be conscious, but move ahead well beyond it.
Okay. And Nirav, so far it's just been a very little amount of time, right? Almost a year since this has come out. Do you think that in the current scenario of the stress test that we've seen so far, it has managed to do well in terms of the MF system? Are there any concerns that you are seeing coming in? And do you think a possibility that the stress test may fail? Is there any possibility of that front as well?
So when this stress test was first introduced, of course, most of us were waiting for it with bated breath almost, right? We were really worried, anxious, what is it going to show up? But surprisingly so, the results came out pretty well. On an average, all small cap and mid cap funds also, for that matter, have been very conscious about their liquidity profile, right? So there was no shocker so far. In fact, even during this entire cyclical downturn that we have been witnessing since a little over 2 quarters now, mutual funds have been holding up, in terms of their liquidity profile pretty well. So, while, we also look at individual portfolios, direct equity portfolios, we realize that mutual funds have been doing a phenomenally good job, at least on a relative basis versus several other products, in terms of managing liquidity risk as well. So the good thing is we have seen it across steep cycles. Although it has been a short period, we have had the fortune/misfortune of seeing it across two different cycles of a cyclical uptrend as well as a downtrend, and it is holding up really well. I feel this reinstates faith into the mutual fund management scheme of things, that they know how to manage liquidity risk.
Okay, Nirav, thank you so much for joining in with us and help our viewers understand this stress test that is done for small cap funds and what they should be doing as well. So thank you so much for joining in with us. And thank you so much, viewers, for tuning in to CNBC TV 18. But up next, you have a closing bell to take you through the last hour of trade.